some good, some bad. Auditors reports. Because the thing about auditors reports, which is really the only thing that we actually own. Remember, the financial statements we don't own. Well, the textbook talks about it in very black and white terms. If such and such happens, this is the type of auditor's report you give. If this happens, I mean, you can give a clean auditor's report. You have modifications. All those things sound sort of black and white. Well, what I can tell you is those of you going into public accounting, this is not a black and white industry. Clients don't see in black and white. We don't necessarily always see in black and white. And we certainly don't always look at things the same way. And auditors' reports become a very controversial topic in some cases. Because what we may want to do, or what we may believe is a proper auditor's report based on circumstances, in a lot of cases the client doesn't agree, okay? The client may think that the auditor's report should be different, or they need a different type of auditor's report, and we think there should be modifications, or we think there should be extraneous circumstances that we want to talk about in the auditor's report, because again, this is the only thing that's ours. They may not believe it. Sometimes you've got restrictions. I mean, you've got bank loans, or you've got SEC, you're a public company. You can't just give them any kind of auditor's report. They're looking for clean opinions. A lot of financial statements, a lot of bank laws are calling for saying, listen, we need an auditor report with a clean opinion at the end of the year. And you may have circumstances that you feel don't allow you to. We're going to talk about some of those circumstances. If you're going into public accounting, that's going to happen. Just like when we get to the ethics, on surface it sounds pretty easy, but do we have ethical situations and things we need to deal with in our personal lives that affect our professional lives? Absolutely. So talking about the auditor's report, what is the purpose of it? I mean, first of all, what we're hoping to do is to provide an independent and expert opinion on the fairness of financial statements. That's what we get hired to do most of the time, okay? We're called upon for attestation services to attest to the fairness of the financials. Companies require that. All public companies require that. Companies that borrow money, normally banks require that. Investors require that. So we're hired to do an audit. And at the end of the audit, the hope is that the auditors can sign off on an opinion that says that they've obtained reasonable assurance, not absolute assurance, but reasonable assurance that the statements are in conformity with GAAP or whatever other basis of accounting we're using. So that's the ultimate, that's what you hope for, that's what the client hopes for. And in the majority of cases, that's what you do get. It's those cases where things are going to be a little different, where you've got problems, where you've got extra circumstances that we're going to spend a little bit of time on. That's our ultimate goal, is to give that type of a report, okay? What's the typical coverage? Well, most of the time, what are we reporting on? We're reporting on the 4 basic financial statements. Balance sheet, income statement, statement of cash flows, and a statement of retained earnings or an equity statement in a lot of cases. Those are the basic 4, and that's our goal. Do you have to have 4? No, you can audit a financial statement. You can give a balance sheet only audit. You're allowed to do that. I think the requirement is that you do an income statement, you're required to do a cash flow. Otherwise, you're not according to GAAP. But we do sometimes, if a client requires, I need an audited balance sheet. You can audit just a balance sheet, that's allowed. So anyway, those are the basic financial statements that we're looking to provide an opinion on. And we're also looking at the disclosures. Let me ask you, have you in any of your classes discussed notes to the financial statements in any depth? Is that something that's talked about? In the back of the head. If your head going up, so let me ask you. Which class, where did they talk about notes?
You mean the footnote?
Yeah, where is that discussed?
So the second intermediate accounting
Excuse me?
intermediate accounting too.
Intermediate accounting 2, is that a chapter? I've never taught intermediate accounting.
I mean, I don't know.
It's not a chapter. It's like when you do plant, property, and equipment, or bond.
They don't talk about the disclosure. But generally speaking, disclosures are not discussed as a topic, correct?
Yeah, no.
That's unfortunate. I don't know why. Because again, I guess if I designed an accounting class, I would talk to you about this. Because I think when we do an audit, a financial statement, an income statement, a balance sheet, you guys know what they look like. They're very standardized. But when you get to the back, which can be much more voluminous than the front could be 4 pages, the back could be 104 pages, with the footnote disclosures and all the descriptions and all the other stuff that you can't put onto an income statement. The notes to the financial statements are one of the more difficult things to do. One, while there is some prescribed language, you're talking about writing things from scratch in some cases, describing transactions, writing a footnote about litigation and explaining it in proper English with proper grammar and trying to do it in a succinct manner to explain to a reader, hey, this is the litigation that's out there, or this is the business the client's in. I don't know if that was ever discussed with you, that the first footnote in the back of every financial statement requirement of GAAP is, what does the company do? Because if you really think about it, when you pick up an income statement, and it starts with the line sales, and then it says cost of sales, and then it goes down the income statement, and you look at a balance sheet, it's got cash and receivables and inventory. Well, if somebody doesn't actually tell you what the company does, you have no idea what they do. Yes, they sell something. Yes, they make a profit. Yes, they have assets. They have liabilities. But I can't analyze a financial statement unless at least start with what does this company do for a living. And they got some name like the ABC company. How am I supposed to know what they do? So the financial statement disclosures are an integral part of the statement, something that at some point in time as accountants you'll get involved in. You spend a lot of time with it. And it's a real learning experience in terms of how to do it. It takes years before you're absolutely capable of writing a footnote from scratch. I mean, you use a lot of the prior years ones. You pick up a financial statement, you go to these disclosures in the back. Like I said, they could be 1 page, they could be 100 pages. And it starts with describing the company's business, then it goes into all the accounting policies. How do they do depreciation? How do they account for income taxes? How do they account for inventory? What are the accounting policies for advertising? There's a whole bunch of them that are required. Then they go into things like describing, as you said, the fixed assets, describing the inventories, how much work in process, how much raw materials. You've got to do that. You've got to describe all the debt of the company. You've got to describe all the equity of the company, which in some cases can be rather voluminous, especially on public companies that have issued debt equity in 10 different ways. 6 classes of stock, warrants, options, all things you learn in intermediate 2. All kinds of, all the balance sheet financing, all the leases have to be described back there. Retirement plans, all things that are not necessarily apparent from the face of the financial statements that are back here. This becomes an incredibly important part of a financial statement. And actually it can almost be a course. Or certainly a large part of a course is on financial statement disclosures. Constantly new rules written about them, and certainly parts of GAAP to tell you what you absolutely have to say, how you can say it, what you can say, and what you can't say. So our audit report not only covers the basic 4 financial statements, but it absolutely covers what's in the back, which is, like I said, very, very important part of any financial statement. You pick up financial statements, everyone has to read them. The footnotes are, without the footnotes, you won't know what you're reading. So again, let's start with non-public companies, the companies that are governed under the rules of the AICPA. What are the important parts of a auditor's opinion that has to be there? A title that includes the word independent. You have to say that you're independent of the client, that you're an independent public accountant. That's a requirement. The addressee, like I said, some of these sound sort of, well, of course. But it's really not an of course. Who do you address it to? Well, you wouldn't address it to the bank. You have to address it to the company itself or its shareholders or a particular committee, like the audit committee or the board of directors. Who gets the financial statements it's addressed to is a specific requirement. When you sign a financial statement, it's always signed with the name of the company, not with the name of the partner. So if I signed off on a Cohen Resnick financial statement, you would never see Michael Cohen's name on the face of the financials. It's going to be signed off as Cohen Resnick, then it needs to be signed off by a partner. You do not allow, nor any firms allow their employees to sign the name of the firm. In fact, most firms, we don't even allow the partners. Certain things like that I was able to sign as Cohen Resnick. Other things like financial statements, we only allowed certain partners in our quality control department actually to do the sign-up. They were the last line of defense. They were the last people to look at a financial statement. They didn't want me as an audit partner issuing financial statement with Cohen Resnick's name on it, so they've been checked by quality control. So most firms don't even allow most people to sign things. And the date. You're going to always see on a financial statement opinion two things: a city, state, and a date. Location is important because it matters which office actually issues the financial statements. You might say, does that make a difference? Yeah, it actually does in some cases. Sometimes people want something signed maybe out of New York. It's a sign of, hey, listen, this is New York. There's a big firm out of the city as opposed to, in our case, where's Roseland, New Jersey. So in some cases, some clients, it's important. They're going to be sending this financial statement out to thousands of people. They care where we sign. And it also, I think, makes a difference in case there's litigation, which state would govern. The date on a financial statement, we all, as accounting firms, spend a lot of time with this because that's the date that sort of sets in stone where we're responsible to, time-wise. When I pick up a financial statement, it's one of the first things I always look at. Why? It gives me a little idea whether there's a problem or not. So how would the date tell me if there was a problem in the financial statement? I get a financial statement for the year 2014, and it's dated February 1, 2015. It says, okay, you got the audit done in a month. Within 1 month's time, they were happy. Things were cleared up. They got all the audit documentation they needed to be happy. 1 month later, I got a pretty good feeling on those financial statements. What happens, though, when I pick up a 2014 financial statement, and it's dated September 15th of 2015, 8.5 months later? You said, does that matter? Yeah, it does matter, because my first thought is an audit. Why does it take 8.5 months for the accounting firm to sign off? What took 8.5 months? There's a couple things. It could be nothing. Maybe the client decided, hey, listen, I'm in no rush for this audit. You guys want to do it in the summertime, that's fine. Doesn't matter to me. Come in August. You give me a better price in the summertime. That's possible. That's not normally what happens, though. Normally what happened, there was something wrong. There was something couldn't be documented. We couldn't get legal confirmation. The books and records were screwed up and took 4 or 5 months to fix. We asked for a bunch of documents, they couldn't find them. They had to get some more information. Something held the audit up. And as a result, until you have all your audit documentation and you're out of the field, you're not allowed to sign off. You can't walk out on February 28th and say, I'm 99% done. When I get that last percent, I'll be finished in August sometime, 6 months later, and sign off in February. You're not allowed to do that. When you're done with your audit, you're done with your audit, and that's the date you're required to sign. When you've obtained sufficient appropriate audit evidence to support the opinion. Obviously, by the fact that you waited until September to issue the report, you didn't have it. So you're required to go to the date when you're done. That also means you've got to do the rest of your audit procedures possibly over again. What does that mean? What if I sent out legal confirmations in January and it came back in January and it's now September? I got to go back to the lawyers again and say, anything else I need to know now? Because I'm responsible through September now for any subsequent events. I can't just wait for that one thing. So I've got to go back in and do some more work because I'm responsible through that date for anything that may happen that affected those financial statements. Anybody have any questions about that? Like I said, we always look at that date. We get our management representation letters from our clients with that date on. Those dates have to match. So the date is actually more important than just some number in the bottom left-hand corner of an audit opinion. So let's just go through quickly something we did last time. The paragraphs in a standard auditor's report. An AICPA standard auditor's report, meaning we're talking about non-public companies. First paragraph's always we have audited the accompanying, and it says which statements. Here we're talking about consolidated balance sheets of this company. In this case, it's 2 years. You mentioned both periods of time. Anybody outside there? We're good? Okay. So we mentioned whatever years are covered. In this case, it's 2 years. And then usually the word related is important. The related consolidated statements of income, retained earnings, and cash flows for the year that ended. In other words, these are the statements, they all go together. That's our first paragraph. Standard language. Is this changeable? The answer is no. We are not allowed to change this language. It's prescribed language by the AICPA. It's got to be word for word. I mean, yes, if it's not a consolidated, you're not going to use consolidated. You can't use the numbers at all. But talking about the format, can you use any type of your own format? Absolutely not. The second paragraph is always, what is management's responsibility? Again, coming back to the general premise that accountants want to make clear. Now, is this the way it's always been? The answer is no. Going into public accounting, it's an ever-changing business. During my time, I can't tell you how many new pronouncements, how many times we've changed how we're accounting for things. You're going to account, when you get eventually into public accounting in a couple of years, you're going to account for leases different than I account for leases today, which is different than I accounted for lease accounting when I first started in the business. So things are always changing. GAAP changes, gas changes, and we have played around with these opinions multiple times during my career. They are different wording. These are different words that I learned when I started, and I can't tell you how many times they've changed. We're always tweaking it a little bit. Mostly, I think, to make it absolutely clear to the public what we're responsible for and what we're not responsible for. So the second paragraph tells the reader, hey, listen, these are management's numbers. Management's responsible for them. Management's responsible for the fair presentation, and that they're done in accordance with GAAP as accepted here in the United States of America. Talks about that also they're responsible for internal controls. And that they're responsible for making sure that the statements are free of material misstatement, whether due to fraud or error. It's management's job. That's not the accountant's job. And that paragraph clearly says, it's not our job to put these numbers together properly. That's not what we are here for. The next paragraph says what we are here for as auditors. Our responsibility is to express an opinion. And then it says what the standards say, what the opinion's got to be. And then the next paragraph talks about what an audit is. It gives a clear, hopefully a clear understanding to the reader what an audit is, what it involves. It's picking procedures, in effect, based upon our assessment of risk to make sure the financial statements are free of error. Tells you what an audit also includes evaluating appropriateness of accounting policies and the reasonableness of accounting estimates. In other words, if they're putting reserves for bad debts, we have to look at those reserves to see that they're reasonable, because that's all we can do, and about assessing overall the presentation of financial statements. That's what an accountant's job is. So we define, here's what management does, here's what we do, this is what the audit is, and then we finally then cap it off, say, okay, that in a clean opinion, we believe the audit evidence was sufficient and appropriate in order to provide an opinion, and then boom, we give that opinion. And the opinion, again, the wording is exact. This whole thing that you read is an exact wording, and it doesn't change. In our opinion, the consolidated financial statements referred to above present fairly. Again, the word fair, not exact, in all material respect, again, not exact, the financial position of the company and the results of their operations in accordance with accounting principles generally accepted in the United States. So we've walked through, said, here's what our job was, here's what the company's job was, here's what we did in effect, and here's our results. If everything goes well, we get all the documentation, voila, you've got what's called a clean opinion. This is the goal, this is what you hope for, and in most cases, that's what the client's hoping for. Okay? What do you need as a condition? That you're able to get the sufficient appropriate audit evidence. I mean, that's simple, that's what an audit is. That's what we do. We're going out there to find out if we have enough audit evidence to conclude that the financial statements are free from material misstatements. What's the PCAOB say about the opinion? What do they do differently? Because the opinion in a public company is different than the opinion in a private company. Is it effectively the same thing? Yes. Are the words slightly different? Yes. You got to use the word registered and independent because, again, not all public accounting firms are. Yes? Come on.
Sorry, I have a question. When you were reading about the opinion, most of the first paragraph, you said that there has to be 2 dates there?
No, I said in this case there's 2 dates. We're going to talk about multiple. In this case, they were giving an opinion to 2 years. Okay? There is no requirement in GAAP that you have to give financial statements for multiple years. Other than, and you should know this rule, the Securities and Exchange Commission requires financial statements to be 3 years of income statements and 2 years of balance sheets. They require that. We have clients that say to us, listen, we want comparative financial statements. We want 2 years. Good. That's what we like to give. Why? Because if you're going to read a financial statement, it's so much easier when you have 2 years in front of you. It gives you a basis for looking at it and saying, what changed? Here's my expectations. I can't read a financial. You give me a financial statement to read and say, Michael, I want here's a financial statement. Read it, pick it apart, tell me what you've done. I can do that. I should be able to do that after all these years. In all due respect, it's something I've always been able to do well. I'm able to dissect a financial statement and make some comments about things that I think look right or wrong. It's infinitely easier if you show me last year's stuff. And I look at last year's and this year's, and I go, okay, this is what my expectations are this year based on what you tell me about the business. I'll make a lot more comments. That being said, we like to give comparative financial statements. When asked, we do it as a normal course of business. So if we audited 2010, when we do 2011, we do 10 and 11. Then when we do 12, we do 12 and 11. We put them next to each other. And we issue them that way. Most readers want it that way. But we don't have to. We have clients who say, listen, you issue 10s this year, I'm going to put it in the drawer. And you issue 11s next year, and I want 11s by itself. And they usually have a reason. Maybe they're going out to a new lender. Maybe they don't want people to see last year's. Their call, no requirement that you have to put 2 years on a piece of paper, except for the public companies. The SEC says, you issue a financial statement, we need 3 income statements. We need 3 years of income statements, 2 years of balance sheets. We don't get those. They're not acceptable documents. The only time you don't give them is you haven't been in business for 3 years. You can't get 3 years, but I've been doing it for 2. So anyway, differences from PCAOB to AICPA, words registered and independent in the title. It references, instead of GAAP, it talks about the PCAOB standards. Less detailed discussions of management and auditors' responsibilities. And it includes an additional paragraph talking about internal control, that you have to report on the internal control in addition to reporting on the financial statements. That was as a result of Sarbanes-Oxley. And it doesn't have section headings. You look at a financial statement of a AICPA non-public, each one of those paragraphs had a heading over it. PCAOB doesn't have it. Effectively, other than the internal control, you're doing the same thing. Now let's talk about, well, now we're going to get into when we're now going to be doing some different things. We're going to talk about stuff that's different. Right up to now, we've talked about, hey, pretty standardized. This is our standard auditor's report. Same words with every single one of them. What happens when we've got other circumstances? Oh, an unmodified opinion, or what is known as a clean opinion, is what we've been talking about. Standard report, concludes the financial statements are not misstated, and there's no need to alter the report for any situations. Number 2, what's called an emphasis of a matter paragraph. Let's understand what that is. We as accountants make decisions sometimes, that we want to wave a white flag about something. I'm not sure I always agree with this. But here's what the accountants have determined. Sometimes we want to tell the reader, we want to smack them on the head and say, we want you to read something carefully. We want to, years ago, does anybody know, you heard going concern before. Anybody want to explain the going concern? Somebody. What's going concern?
The company is able to have their business without defaulting their payments for at least 1 year?
That's part of it, yes. That you're on the right track. Anybody else want to give me a little tighter definition on Chris, right?
Yeah.
You remember going concern from financial accounting?
Yeah, basically, you have to work under the assumption that the company's going to live on.
Exactly. Not only that, that's part of it. Will the company be in business a year from today? It's that simple. Do you believe as an auditor that the company will exist 1 year from the balance sheet date? So if you're auditing December 31, 2014, and you're there in February of 2015, you have a responsibility as an auditor to look and make a determination, and we're going to talk in a couple seconds what they are, whether there's any circumstances that scare you into believing that this company's not going to be here next year. Because if you believe it's not, you have a requirement under GAAP, under GAAP actually, to tell the reader that. You've got to put in a paragraph what's called an emphasis of a matter and say, hey, listen, reader, I believe you're smart enough to read these financial statements. You're going to see the company's losing money. You're going to see the company has debt coming due. But I want to make sure you read this, okay? I don't want you to miss this and later on come back and tell you, the accountant, hey, you didn't tell me that this company's in trouble. So it's what's called an emphasis of the matter factor. It's your choice. Now, why is this a problem? You want to know how many fights I've seen with clients with a going concern paragraph? You think they like that? Nope. You think they want a paragraph in their opinion that says, my accountant thinks I'm done. That's what it says. It says, my accountant's not sure he's got a client 1 year from today. And clients like having to hand that to their vendors, to their bank, to the SEC, and says, my accountant said the numbers are okay, but I'm on death's door, okay? You want to know the fights? You have any idea of the fight? Do you think the client believes what you think? Or do they always see that, the primrose path? I know the sales are going to turn around. Yes, I've been losing money for 5 years, but I know this is the year. This is the year everything goes. What do you mean I don't have any customers anymore? I have plenty of customers. The loan that comes due, I know the bank's going to renew it. How do you know? I just know it. The banker's my friend. Bullshit. And you as an auditor have to say that. You have to be able to sit with a client and discuss this. Does it ever go easy? No. This is one of those times you don't like your job. I'll be honest. You're sitting with a client, and what are you telling him? He's sitting there with his wonderful business, and you're telling him it sucks. And I'm serious. You're telling him you got a problem. He knows it, but he doesn't want to admit it most of the time. Why? Because they're proud of their businesses. Do they think the bank's not going to renew the loan? Of course not. So that's what one of the things that's called an emphasis of a matter paragraph. It has to do with going concern. Another one's a change in accounting principles. What if the accounting laws change this year for a particular thing? What if they change the lease accounting rules, okay? So that in 2014 you account for leases this way, but in 2015 you're going to do it a different way. You got these statements with a change in accounting principle, perfectly legal. You got to tell the reader. You don't let the reader wait till he gets to page 50 in the footnotes to read down on the bottom page how they change the accounting policy. Emphasis of a matter. So we've got a modification of a report there. It doesn't say that the opinion's modified. We still say, in our opinion, the financial statements are fair. What we're telling the reader is, we're waving the flag and saying, read these closely. There's something you need to know. We want to emphasize something to you. Other matter paragraphs. Sometimes there's a couple other things, we're going to talk a little bit more depth about this, that you have to tell the reader. Or you have to put another paragraph on. Sometimes reports, although audited, are not for everybody. Sometimes you tell a client, hey, listen, client says, I need an audited report for such and such a purpose. And you say, okay, we'll do it for that purpose. But you can't go take this audited report and go do anything else you want with it, okay? You can't just go out and decide you're going to do a public registration with it. You're going to go out and sell securities with this. Right? We don't want you doing that, okay? You can use it for the purpose you said it's intended for. You can add a paragraph on called another merit paragraph and says, this report is only for the purpose of such and such and such and such. You can do that. Also, you use this paragraph, we'll talk about this later. There's no rule that says that a company and its subsidiaries all have to be audited by the same auditor. What happens when a variety of auditors get involved in an audit? We have this all the time. I have a large company that I've audited for years that's a subsidiary of a Swiss public company. It is audited everywhere in this world, a large public company that's sold off the Swiss stock exchange, based in Bern, I think. However, they decided years ago they didn't like the Big Four firm here in the United States. They didn't like them. They were sick and tired of dealing with the U.S. subsidiary, and they came to Cohen Resnick, J.H. Cohen at the time, and hired us. Got permission from the parent company. So if you look at that particular company's audits, you would see Big Four, Big Four, Big Four, Big Four, or one of their largest subsidiaries is audited by Cohen Resnick. That could possibly cause another paragraph, okay? And we talk about this in here with group financial statements. When two or more CPA firms are involved in an audit. And the group auditor does not necessarily want to take responsibility. Group auditor could take responsibility for everything, or the group auditor, meaning the auditor at the top, could say, listen, of the numbers I audited 82% of them, and somebody else audited 18% of them. I'm taking responsibility for what I did, the other accounting firm's taking responsibility for what they did. So there's all kinds of other circumstances that can dictate changes in the opinions. There's also modified opinions. Remember, those were additional paragraphs, but the opinion was still a clean opinion. What about other types, what are called qualified, adverse, and disclaimers? A qualified opinion states that the financial statements are presented fairly, except for. I have a very large related, I told you about it, I apologize. The largest company we have gets a qualified opinion. For a reason I just never understand, is that the principal of the company refuses to do depreciation in accordance with GAAP on the books. I don't know why. I can't make sense of it. Because, we don't want to do book depreciation. Just do it the same as the tax return. We said that's not generally accepted accounting principles. That's makers, that's tax rules. You can't use tax rules for financial statement depreciation. That's not in accordance with GAAP. I know, but we don't want to go through the aggravation of making the calculation. We go, well, we'll make the calculation. No, we don't want you to do that. We go, well, you're getting a qualified opinion. Because your financial statements are now materially not in accordance with GAAP for this one item.
What's the difference in material?
What?
What's the difference in material?
Yeah, it's material. If it wasn't material, I wouldn't care. But the fixed assets are materially, there's millions of dollars of difference in depreciation, and millions of dollars of difference in presentation in terms of the net book value of these particular fixed assets. It's a company that's very fixed asset dependent. They just don't do things in accordance with GAAP, won't do them in accordance with GAAP, then we go fine. You're getting a qualified opinion, and they go, fine, we don't care. Our readers don't care, our vendors don't care, we're still very profitable and nobody cares. And we went, fine. So we issue qualified opinion on this company all the time. I don't argue with the principle anymore. I don't understand it, but I'm arguing it. An adverse opinion. You may ever see an adverse opinion, and in all honesty, I've never seen one either. Because what happens if you get in a circumstance where you have to give an adverse opinion? Either the client fires you, because they can't possibly put up with an adverse opinion, or you somehow come to some resolution where you can get done what you need. The adverse opinion states the financial statements are not presented in accordance with GAAP. So like I said, I've been doing this 46 years. I've never run into one of these. They exist. They've always existed. You're basically telling them, here's the financial statements, they're a piece of crap. They're no good. Think about a client hiring you to issue financial statements that are any good to them. You think if you're a lender, they're going to accept adverse opinions? Of course not. I'm a lender to a company that here's my numbers. They're bad. They're wrong numbers. Here they are. Well, nobody's going to pay me to do it. You're going to get in fights with the clients, so it doesn't happen. Does it exist? In theory, yeah, it exists. Could it be on a CPA exam? Sure. Could it be on one of the questions on your homework? Yes. If you ask me if I've seen it, no. Disclaimer, you don't see this too often either. What happens in this case is you find some auditor who can do it. This is when you can't ask an opinion. You can't come up with one. The numbers, you either have such scope limitations, in other words, you can't audit the company. It was like I said, I told you that case we had a company in the Caribbean. We had a string of jewelry stores, 100 stores in the Caribbean. They hired us to be the auditors. Their records were an atrocity. They couldn't verify inventory. We couldn't verify the pricing of the inventory. So as a result, I mean, inventory and something like that is a significant number. We couldn't verify it. As a result, if you're ever going to give an opinion, we could give us a disclaimer. Well, once you do that, the client looks at you and goes, well, what's a disclaimer to me? In other words, you're basically saying you haven't done anything. You can't audit the numbers. So again, you see circumstances that are covered under generally accepted accounting standards, but rarely happen in the real world, okay? At this point in time, what happens if the client has got records that are that bad? They got a problem because they can't get any auditor of any substance who's going to come in and put their name on it. If you talk to a client and you say, hey, listen, they come to you and say, hey, Cohen Resnick, you want to do an audit? And they go, well, have you talked to anybody else? And I say, yeah, we've got 3 other accounting firms in here and none of them can do the audit. So if they couldn't do it, we're probably not going to be able to do it either. So you're not going to see these things happen too often, but you have to understand they are covered in the instance that those circumstances exist. And they do exist, especially the disclaimer. There's a lot of companies that are unauditable. Yes, sir.
How many matters that are informed by GAAP would consider the qualifying fees turned to adverse opinion?
Well, we're going to get to that. It's not a matter of the numbers, it's severity of them in there's a word for it, come off in the air. This is governed by absolutes. It's governed by your gut that says, at a certain point in time, and this is where you sit and you get a bunch of accountants getting into a room and debating things. Some of these things are, you get 10 people in the room, and we've had these. Somebody will say, we're fine, I think the numbers are okay. And somebody will say, I don't think you audited them. Somebody else will say, I think I did audit them. Did you cover it? Did you do enough work? Well, there's no absolutes to that. This is always, a matter of sense, feeling. Did you do enough audit work to verify something? Is it risk? Is it a number I care about? Is it material? Okay? So let's go back to this going concern concept. We talked about this briefly a couple seconds ago. Very important. It's a requirement. Now, what's the requirement? You're not required to perform procedures But you've got to evaluate the assumption. Now, if you do it in the event that you see a problem, you don't go into a company that's making zillions of dollars, has plenty of profit, lots of equity, lots of good assets, and go, I've got to assess its going concern problem, or there's a going concern problem. You don't. Now, could there be a problem with a company that's doing that well? Sure. You look at what happens if in your circumstance, 3 months today, senior debt on the company comes due, and they owe millions and millions of dollars, and you don't see cash in the bank to pay the loan. Well, you're going to say, hey, listen, what happens if the loan is every minute? So let's look at some of the circumstances that dictate conditions that require you as the auditor to look at the going concern issues. So cash flow statement, top section, you've already got to do it. Cash flow from operations. What if we've got negative cash flows from operations regularly? In other words, we're running our business generating negative cash flows. We may have enough cash because we're borrowing from the banks to keep going, but the business itself is generating negative cash. We're spending more than we're bringing in. But that's certainly a condition that's going to give you a concern of whether the company can keep going. You can't do that forever because people stop lending you money. Defaults on loan agreements. We have a requirement. This is one of those ones you say, where do audits go bad? Where do you find bad audits? Here's one. Number 2. We have a requirement. Absolute requirement on every audit. We need to read loan agreements. Not just confirm with the bank, hey, we owe $1 million. Is that the right number? Yeah. Loan agreements typically have clauses in them where you need to meet what's called financial covenants and other considerations, things you can and can't do. It's an absolute requirement of the audit to read the loan agreements, excerpt the important parts, and check the audit to make sure that companies don't violate them. Silly little things can be. Lots of loan agreements will say, no dividends to the stockholders. Why? Hey, the banks will say, listen, I want to make sure I'm getting my money before you do. So you can't pay stockholder dividends. Another one. Ceiling on capital improvements. You want to spend money on new buildings? That's fine. You can spend $500,000 a year. Anything higher than that is a violation of the agreement unless you ask our permission first. Why? I don't want you going out and spending on a brand new building and spending $20 million on a building when you owe me money. So most bank loan agreements have what's called financial covenants. Maybe an income requirement, maybe a capital, a debt equity requirement. Could be a number of financial covenants. Assets, your current liabilities to current assets. We are required, as auditors, to check those covenants. We're required to disclose the covenants. When we write a footnote about the loans, we've got to say there's certain covenants. And if the client is in violation, no matter what the violation is, we need to stop the audit and get a waiver from the bank or possibly reclassify the debt. What does that mean? What if it's long-term debt? The loan agreement says in the event you violate this agreement for any reason, the debt's immediately due and payable. Happen all the time. All the time. I wouldn't say to you, you can pick up almost any audit where companies have major debt and you don't have issues with loan agreements and possible defaults. Do I see us trip up there on this stuff? Every once in a while, that becomes the problem. Did you read the loan agreement? Did you notice that they violated a covenant? What did you do about it? Because if the reader doesn't know they violated a covenant, you could have a problem. You could have a company defaulting on a loan, can't pay the loan, go out of business, investors are screwed. Whose fault? It's yours. It's the auditor's fault because you didn't disclose it and you didn't notice it. So you've got to go into loan agreements to check whether you got a problem. Did you do something? You have a perfectly successful company who violates a loan agreement. They don't even know they do it half the time. Could be some silly little clause. Adverse financial ratios, working capital, whatever the ratios that you learned in financial accounting, lots of times they are spelled out in loan agreements that they need to maintain certain working capital ratios or certain financial ratios. You can look at them yourself, and if you see the financial ratios are deteriorating, maybe you have a going concern problem. That's why we teach those. They actually mean something, those numbers. Work stoppages. What if you've got to call out the unions? And all of a sudden you find out there's a strike. Well, you possibly have a going concern problem? Yeah. The workers aren't working, the company's not doing what it's doing, how's it going to pay its bills? So work stoppages could be a going concern problem. You as an auditor are responsible to be looking into those. Legal proceedings, that's always a problem. What if you got lawsuits? Whatever they may be, could they be an impediment for the company continuing into the future? Now, you could say, yeah, what if I, as the auditor, trip across any of these circumstances during the course of my audit? What do I do? Well, you can't do much yourself. What you've got to do is sit with management. This is how we decide. And this is why you get into these, I'll call them pissing matches with clients, because you trip over these things. And the client says, yeah, but the work stoppage, we'll be back to work in a month. This is where the auditor-client relationship gets tested. Because you're sitting there, and your requirement is to document. If you're not going to express a going concern paragraph, you need to, as an auditor, be satisfied that the client is satisfied you, that they've got a cure for it, and the cure makes sense. And the sense can't be, yeah, I think the bank's my best friend, he's going to renew the loan, okay? You've got to show some type of documentation. You need to satisfy yourself that whatever the condition is that raised the red flag to you as the auditor, you feel satisfied. Yeah, they've got a negative cash flow from operations, but they've cut out the one part of the business that's losing money. Yes, Scott.
So having one of these issues doesn't mean that it's going concern.
Not necessarily.
It's just a red flag that you would need to.
Remember, auditing is, you know what, this comes back to, where is he? Right there. Turn?
Yeah, you're gonna keep picking on me the whole semester?
Yes.
Sorry.
That's okay, you brought up a very good point. You brought up a good point, that's why I'm picking on you. It was a bad one, I wouldn't remember. When he said that he read an article that said, could we use robots, computers to do all our auditing? The answer still becomes no, because now when you say and I'm not picking on you, Pete, for bad reason, because I don't think ever you're going to be able to sit with a client and have a computer talk to them about these circumstances. You're going to sit there and say, that makes sense, that doesn't make sense. Here's the documentation I need to satisfy myself. And this is one of those situations, turns into a fight every time. Because there's not a client alive who wants a going concern paragraph in their opinion. And you point to these and you go, hey, Mr. Client, you're losing money in your operations. You got a default in your loan agreement. You got adverse financial ratios. I know there's some lawsuits out there. Yeah, I got an issue. Wondering you're going to be here next year. They don't want to hear it. They go, yeah, blah, 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 blah. But yeah, but my numbers are good. They go, well, I'm sorry. My requirements as an auditor is to put a paragraph in. I don't want to see that paragraph. I do it to another account. It's called opinion shopping. What do clients do sometimes? They do something that's very bad. One accounting firm tells them one thing, they go down the street and they talk to someone else and say, well, would you see my concern problem? You want to be my auditor? The accounting firm, well, geez, maybe we can get past that going concern and we'll get a new client. So that's what going concern's all about. And what would the paragraph read like? Let's read a paragraph here. Company financial statements have been prepared, assuming the company will continue as a going concern. As discussed in Note 1 of the consolidated financial statement, the company has suffered negative cash flows from operations, has an accumulated, this is where again, who wrote this should be shut. It says accumulated deficit, obviously deficit. There raised substantial doubt about the company's ability to continue as a going concern. This is great. Management's plans in regard to these matters are also described in Note 1. The consolidated fanatical statements. Yes. I read that, I can't tell you how many times you go, you gotta be chuckling. This is really something for having a moment. I guess the statements are fanatical. I think it's financial. Do not include any adjustments that may result from the outcome of the uncertainty. Our opinion is not modified in respect to this matter. So we're not changing our opinion. But what did we do? We emphasized the parity. Hey, reader, bad company. Go read No. 1, and in it, it's going to tell you what management's doing about this, okay? That's what it did. It told the reader, hey, the numbers are what they are, but we got a little problem here. If you're not smart enough to notice it, we're pointing it out. Go read No. 1, you form your own opinion on this, okay? There's a lack of consistency paragraph. Lack of consistent application of accounting principles, as discussed in Note 5. The company adapted statement of financial accounting statements, update, blah, 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 and our opinion's not. So we're just telling the reader again, hey, 2 years done differently. What are some of the matter situations? What are discretionary? In other words, me as an auditor, it's up to us. We want to put an emphasis of the matter in. Okay? A risk or uncertainty. Is there something material risk about this company that we want to point out to the reader? It could be anything. What if there's a material risk? The company buys all their products from one particular company. 80% of their products from one particular company, and the company that's their supplier is in significant financial trouble. Do I have a risk as a company that I'm going to continue, and I may go out of business because my supplier may go out of business? Absolutely. Do I as an accountant, want to possibly point that out in the footnotes? Yeah, maybe I better do that. Because what happens if the company goes under this year because the supplier went under and I can't get product anymore, and I can't do what I do? Significant related party transactions. Do you understand? Everybody understand what related party transactions are?
Vendors.
What?
Vendors.
No.
Subsidiary companies that are part of the company. Or,
Yeah.
or other companies that are related directly to
For people that are related, okay? I ordered a significant chain of convenience stores. The convenience stores, the properties are all owned by the most of them are owned by the principal shareholder of the company. So you have an amazing amount of rent expense on the books that is paid to companies owned by the principal stockholder. That's a major related party transaction. Why is related party transaction so important? Does anybody know? Why do you have to tell them the new reader about related party? Requirement, FASB, I think it was 57. Related party transactions disclosure. Why?
Because related parties mistakenly from fake transactions.
Not so much fake transactions as much as it's not governed by market numbers. They're not fake, but they're like in these leases, okay? These leases could be any number. We can adjust these numbers. You can make them up or down. It's not based on market. It's basically self-dealing, okay? You're dealing with yourself. You're dealing with your mother. You're dealing with your kids. You're dealing with other companies that you own. As a result, the reader has to know that the numbers are not necessarily governed by true market transactions. We can adjust it. If I'm selling merchandise from one company I own to another company I own, I can sell it at any price I want. I don't care what market conditions are. If I have a tax reason for selling it for a higher price or a lower price, I might do that, okay? But if I want to sell it at cost, because that's what I determine, I'm going to sell it at cost. Now, most people don't sell things at cost, but if that's a major part of my financial statements, I need to tell the reader, hey, we have a lot of transactions where we're dealing not to third parties, but with ourselves. So related parties are a very important disclosure. It's a requirement in GAAP that material related party transactions are disclosed in the financial statements. Companies are a component of a larger business enterprise. You're giving an audit of a subsidiary. You've got to say, hey, listen, this company is owned by somebody else. That can have an effect on it. This is not a company that survives on its own. It's owned by someone else. Unusually important, significant events. You had a major thing happen this year that affected the financial statements, good or bad. You might want to put an emphasis paragraph in again that says to the reader, hey, you better go look at this. You want to know that this happened. And then anything that materially affects comparability, other than accounting principles. You want to say, hey, listen, things are dramatically different. You got to read the financials. Sales went down a lot this year. Why? We closed one of our 2 plants. Okay? What we're effectively doing is telling the reader sometimes, we know you're smart enough to read the financial statements. We do want to point something out to you. We want to sort of give you an arrow in the direction of something we want to make sure you know is important. So if comparability changes dramatically, there's nothing wrong with the auditor putting a paragraph in. Now you notice the wording at the top. Auditor discretion. Auditor discretion. This is not governed by rules. This is one that says, up to you. This is where you as an auditor say to yourself, what kind of a risk do I have? How important is it for me to tell the reader that something's happened I want to point to? Now, this is where, again, you and clients can have a debate. This isn't something you can say, well, it's your opinion. You can write what you want, and that's true. It's your right as an auditor to write what you want. It's their right as a client whether or not to hire you. And this is where it gets a little tricky. This is where the relationship, the auditor-client relationship, which has been evolving over years, is tricky. You're trying to be independent as best you can. And that's important. Keeping an independence and doing things what you think are proper. But you're also trying to make a client happy sometimes. And sometimes those 2 things are at direct odds. That's like going concern. Think about it. You're never going to have a happy client when you're telling them their business sucks, okay? You're just not. And some of these things, well, some of them like that. The fact that the company's got a party transaction, there's one. Sometimes clients don't like to point them out too much. They can even debate what's a related party and what's not. Well, is a cousin a related party? Well, we could debate whether, your cousin's a related party under the accounting rules. Yeah, your kid is, but is your cousin? So let's talk about these group financial statements. Does this happen all the time, especially today in this world? Since Sarbanes-Oxley, many companies have multiple accountants. Used to be you hired an accountant, did everything for you. You're my accountant, you do my taxes, you do my audit, you do my consulting, you do everything. Especially globally. If you have companies that operate globally, why don't companies hire the Big Four? Well, it's easy. I call Ernst & Young, I say I'm in 500 countries, they're in 500 countries, you give them the audit, they say we got it, yeah, we got it covered. Okay, well, yeah. We've got offices everywhere, E&Y or whoever the firm might be, any of the 4 firms will take care of the audit globally. But what happens when you don't have the same accounting firm everywhere? So we look at this circumstance. The consolidated parent, we're looking by what's called the group auditor. And this is the exact circumstance we have on this one client of mine. Very nice client. The group auditor is a Big Four firm in Switzerland. They have subsidiaries all over the globe. In most cases, the group auditor is also the subsidiaries auditor. Different office, obviously. The Swiss don't go down to Brazil, or they're not going to China. They've got an office in China. They got an office in Brazil. And when we get the subsidiary C, which happens in this case to be the North American subsidiary located in Roseland, New Jersey, somewhere around 4 iron from my office. This one happens to be, in this case, audited by what they call a component auditor, which in this case is Cohen. So you've got Big Four, Big Four, Big Four, Cohen. Okay? Doesn't have to be those, it can be anyone. Does it happen all the time? You can have that circumstance. What do? As a group auditor, you got to look at the circumstances. First thing you do, and we do this all the time when we're the group auditor, is you have to look at the competency level of what you believe to be the component auditor. Luckily, in this case, the Big Four firm, which is our firm, is a quality organization that they can accept the work of, okay? Now, I'm not trying to just disparage on any particular firms, but this is a fairly large company. It's about a company that does about $300 million in sales, does some leasing of equipment. It's got some rather complex accounting. So you would need an accounting firm that you felt had the competency level and the understanding and the ability to handle a company that size. You certainly wouldn't expect to find a two-man accounting firm in there auditing a $300 million company. It's just not going to happen. So you've got to first determine who the auditors are, okay? Then, normally the group auditors and the component auditors get together. And in our case, that's what happens. We get a letter at the beginning of December with instructions in effect. Here's what we want you to do. Here's your due dates. Here's what we need from you. And the whole bringing us into the audit team in effect. The same type of instructions they're sending to their own firm in Brazil or China or wherever they are. They're sending them a set of instructions to us here. They then determine whether they'll be able to get the necessary information for the consolidation process. In other words, don't forget, the company in Switzerland now is consolidating all these companies from around the world. Are they going to get the necessary information from us here in the U.S. in order to do the consolidation process and do it timely? And then they're also going to check whether, again, we work in a regulatory environment that's actively overseen, okay? Well, they're going to know that here in the U.S. So then in this case, they're going to have full confidence in us to do our job. They also have to tell us what they're going to do with our work. We don't just send them the work and they do anything they want. We have to know how we're being included, because we're now in an audit of a public company. We have some responsibility. We have to communicate all our ethical requirements. We have to say that we're independent. We have to write them letters confirming our independence from the company. We can't be sitting around owning stock in this company. We have to give a list of related parties if there are any. And then they communicate significant risks. They communicate to us, we communicate back. When it's all said and done, the group auditor has two choices. You have one of two choices. The group auditor either makes no reference in their opinion to the component auditors, or they do. They have a choice of either putting us in or not. What does that mean? If they don't put us in, that means they're taking responsibility for our work. In our case, that's what they do. They do not put in the opinion, hey, we audited 90% of this company, Cohen Resnick did 10. They come in, they know the quality of the firm, they check our work papers, they come over here, a whole bunch of people from the Big Four come over, they go through our work papers, make sure we've done the job in a conformity with their requirements, that we've done a proper audit, that we've done enough documentation, and if they're happy, they make no reference to us in the financial statements. You wouldn't know reading this company that this Big Four firm audits this company. You also have a choice of making a reference. Now, what you can say, listen, I'm not taking responsibility for them. We audited 82%, they audited 18%. It's usually based upon sales and income. So you don't go down every balance sheet under and say, we did 30% of the inventory, they did 70, 60% of the receivable. You just usually go upon sales to get an idea. There is, and I'll talk about this in the books, you do have a requirement though. You can't be the group auditor and then say we audited 4%. But I can't take that inside over the business. You have to do a certain percentage of it. You have to be substantial in the auditor. You can't go in there and go, well, I audited 4% of the sales and 2% of the net worth, but I'm the group auditor, and other accounting firms did the other 98%. You can't sign off on it. Nor would you want to take responsibility when you hadn't done most of the work. So most of the time, you're not allowed to be the sign-off auditor and reference other accounting firms unless you're willing to, unless you've done a substantial part of the work yourselves. So we're not going to spend a lot of time on this slide. This talks about what procedures an accounting firm would do when they're not making references to the other accounting firm, which is most of the time accounting firms don't want to talk about the fact that we only did some of the work other people did. The rest of it, they want to take credit for the company. They want their name on the financials. So this is a slide, if you want to read it, I'm not going to go into detail. It talks about how significant the subsidiary is and what the audit procedures are based upon how large or small and the risks. And this gives you a report again, if you did know. We did not audit the financial statements, blah, blah, blah. Which statements reflect total sales, 27% here. And that's effectively what you would say if you're not taking credit for all the work yourselves. When we have departures from GAAP, what do we do? We define a departure from GAAP. What do we do? Well, first of all, if we determine that a departure from GAAP is immaterial, we do nothing with the opinion. And you get departures from GAAP all the time on little stuff. I have a company with very small receivables. They don't use the reserve for bad debt method. Is that a departure from GAAP? Yeah. Is it material? No. Would I modify my report for it? No. What if I have a material departure from GAAP? Qualified opinion. That's exactly the case of that client of mine I talked about that doesn't do fixed assets. It's not pervasive. They don't depart from GAAP all over the place. They don't have bad accounting records. So it's not a pervasive problem. They just don't like doing fixed assets right. So we have a material amount. Does change the balance sheet materially. It changes the profit and loss statement materially. It doesn't bother us a lot because all it is a non-cash item. That's what we reconcile ourselves. There's a footnote that explains what the difference would be, but we're talking about a non-cash charge. Depreciation is too high or too low. It's not something that when you're analyzing the results of operations and you add depreciation back, you get real worried about, but it's wrong. So we have a material departure from GAAP, we qualify the opinion. But what if you've got what's called material and pervasive? Then what you've got all kinds of problems. So they define pervasive in the accounting literature. It's not confined to specific accounts. If confined, they represent a substantial portion of the financial statements. In other words, 90% of the balance sheet is receivables and they're all screwed up. And relation disclosures, they're fundamental to understanding the financial statements. So you look at the numbers and say you can't understand them because they're just so wrong. And if you've got material and pervasive, again, you come back to what's called an adverse opinion. Again, those are the rules. You're not going to see it, or I hope you don't see it. If you've got a departure from GAAP, you're going to have a footnote, and this is a perfect example. You talk about it in the paragraph, and you tell the reader, we do it in hours with the bad depreciation. Here's one where they're not capitalizing leases properly. You have to disclose that they don't do it properly, and you have to disclose, hey, if they did it right, this is what the numbers would be. That's why it makes no sense with me with our client with the depreciation. They go, we don't want to calculate book depreciation. They go, well, we have to because we don't know how materially wrong it is until we calculate what the right numbers are. And we're going to calculate the right numbers. So we do the work. They just want to do it. And I beat my head against the wall for enough years with them on this one. Again, we talked about adverse opinion. Let's not go crazy here, okay?
I thought we were not allowed to make changes to the financials.
We can't. Well, we don't make a change. We don't change their numbers. But we do have to tell the reader they're wrong and by how much. So we go and calculate book depreciation because we need to. Otherwise, we don't know whether we have material departure from GAAP. How do we know? Yes?
They just, in the process, do you guys advise them and then they go back and fix it?
They might, if they want to.
So that would only happen if they don't want to. They disagree with them what they should be doing.
The funny thing in this stupid circumstances, like I said, I say it the way it is, as you know. I have never, with this particular client, got the understanding of why. It doesn't make sense because A, I don't think it materially affects the real reader's financial rating. when you read a financial statement and you're looking at operations, normally you have a tendency of adding back depreciation because it's no cash to it. It's a non-cash charge, okay? So if I'm looking at how this company is really doing, a lot of times I'm looking at the statement of cash flow from operations. We've explained to the client, we'll help you with the calculation. It's no big deal. In fact, we have to do the calculation to know how much material you're off. Yes. Ever had an argument with somebody and you can't understand the other side and then just give up? All the time, right? This is one of those. This is just one of those. I just walk out afterwards and go, why am I arguing about something? I get this one and I go, well, we don't want to know it. And I ask him.
You can always run to us. We'll listen.
Yeah, yes, I understand. You don't have a choice. You're paying to listen to me. Okay. Now, I'm going to screw up the next couple of slides too, by the way. There's other circumstances we got to talk about a qualified opinion. Some of them are very legitimate. We're going to talk about what's called a scope limitation. Are you going to ever run into scope limitations in your career? Answer, yes. You will get scope limitations. Some of them for a very good reason. Other times, not such a good reason, okay? Number one, imposed by circumstance, scope limitation. I come in to audit my client at the end of the year, and I go, I need the receivable records. I need the sales records for the summertime. And they go, bad news. We had a flood. They were all destroyed. We had a fire. My controller ran off with them. Whatever the reason. We don't have them anymore. We didn't do anything bad. We're not bad people. We don't have those records. They're gone. I've got a scope limitation. I can't do what I want to do. It's not the client's fault. He didn't burn the records, but yes.
How do you know you didn't do anything bad?
Let's assume you know there was a fire.
Okay.
You were there. He called them. Let me tell you something. I would hope if my clients had a fire, they'd call me up. Okay? I hate to find that out later on. Like, what did you get here? Didn't you know my factory burned down this summer? This is a true fact. This is a true story. It's a sad story, but true.
Same time.
We have a client who owned a very successful company that manufactured gunpowder. You want to know how many times the plant blew up during our tenure with this one? How many times the plant blew up? I mean, blew up. Not a minor fire. We're talking about Johnson. We're talking, unfortunately, about dead employees. Bad to the point where the state of Pennsylvania, where they were originally housed, said to them after the last explosion, you're not rebuilding in Pennsylvania anymore. Take your business elsewhere. We're tired of you blowing up. You can make this crap up. I don't. They manufactured gunpowder. Very successful. Very profitable. #1 customer, the U.S. Army. But they had some bad problems with blowing the company. What?
How many explosions before that?
I think it was 3 or 4. They were tired of blowing up the plant. The state of Louisiana took them in. They did. They moved to, I forget where, somewhere near Shreveport, Louisiana. And I was very fortunate in convincing the client that they needed new auditors because they could get an auditor in Shreveport for the same price as us, but we would have to charge them all the travel costs to get to Shreveport. Shreveport's not easy to get to. You got to fly to New Orleans and then get there. It was expensive. And it wasn't a big company. It was only a $3 or $4 million company. So we eventually convinced them to get new auditors down there. It was like $12 or $15 or $20,000 audit. It wasn't worth us traveling to God's country, Louisiana. Nothing against Louisiana, nothing against it, but it was not a place I needed to send 3 or 4 New Jersey auditors hiking in the middle of nowhere when they had county firms in there for the Unmodified. But the fact of the matter is, we had circumstances beyond our control. Most years records were gone. Okay? Number two, due to the nature of the audit, this happens all the time. Cohen Resnick, we need you to come in and do an audit for 2014. The bank's going to lend us money, we need audited financial statements. Well, that's great. You hired us just now to audit 2014. We got a problem. But you need a complete set of financial statements? Yep. Balance sheet, income statement, cash flows, whole works. Really? Well, okay. To do an income statement, I've got to be able to audit inventory. I got to have opening and ending. I wasn't there January 1st of 2014. And I wasn't there December 31 of 2014 because you hired me in February of 15. And as much as I would like to audit you, one of the things that's very hard to do is count inventory 15 months ago. I can do a lot of auditing, but I can't count your inventory that's not there anymore. And the first procedure in inventory auditing is counting it, verifying it's physically there. I can verify what's there today, February 4th of 2015, but I can't verify January 1st, 2014's inventory now. I can try some alternative procedures, but it's pretty tough to count something that's gone, okay? So inventory is normally counted on the day that we're audited. So what happens is I've got a scope limitation. I'm engaged too late in the year to observe the client's inventory. I can't do alternative procedures. Now, I can maybe verify an end of the year inventory. I'll be there for that. What happens in those circumstances is normally we tell the client, you're going to have a mixed bag here. I can audit your year end. Maybe I got hired in November. I got hired in November for the 2014 audit. I'll be there for the December 31 inventory, but I couldn't be there the prior January. You didn't hire me then. So we say, listen, we can do an end of the year balance sheet audit. We'll give you an audited balance sheet. I know what you're going to have on December 31 of 14, but I can't give an income statement. And you tell the bank that. So you'll have an audited balance sheet, but an unaudited income statement and cash flow. Because I can't do the beginning. If I can't do the beginning, I can't verify the front and back ends. Do you understand that? And lastly, this is the one you worry about. That's not, you can't do anything about that. The clients can't do anything to you for you. Go, listen, you don't have records. What do you over my life? That's a scope limitation. Hey, you didn't hire me too late. I can't go to the inventory 9 months ago. Come on. This one, posed by client. This happened. Yep. Client refused to allow auditors to send confirmations to customers. What happens when you want to do audit procedures and the client says to yes, they don't need to do that. You don't do that. I don't want to send letters to my lawyers. You know what? You send letters to my lawyers. They answer. They don't do that for free. Lawyers don't do anything for free. They don't do anything for free. So when you send them an audit confirmation, they answer it. They write a nice letter back in return. And then they send the client a bill for the time you spend writing your audit confirmation. That makes sense. Banks don't even do it for free, I don't think, anymore. And they charge for confirmations. So what happens when the client's a cheapskate, doesn't want to pay for that? You've got what's called a scope limitation. They're not letting you do your job. And you've got to say so. You've got to put a qualification in your audit report that says, we have a scope limitation. Everything's fine except for the fact that we couldn't verify outstanding litigation. Clients aren't going to want that. They'll give in to those type of things when you say, hey, listen, either do it or you got a problem. Or they hire new auditors. They find some auditor that will do it. Now, here's another mess. This person who made these slides was drunk. Because this is not anything to do with a scope limitation. This is the same stupid opinion on the GAAP exception that was before. It talks about the capitalized leases. Disclaimer opinion. Auditor has no opinion. Does it happen? Very rarely. It just, you know, again, we talk and say, okay, it exists. If you're taking a CPA exam, doing homework, there's going to be questions asked about what do you do? You say, oh, it's a disclaimer. But here's an important sentence on here. Not an alternative to an adverse opinion. Client says, listen, You go in and say to the client, listen, I audited this company. Your numbers are all wrong. Everything you gave me is wrong. Client says, I'm not changing the numbers. You say, well, I got nothing but material and pervasive problems. I've got an adverse opinion. You fight with the client says, finally, tell you what, don't give me an adverse opinion, just give me a disclaimer. You're not going to give any opinion. Not acceptable. If it's an adverse opinion, it's an adverse opinion. You can't downgrade and say a disclaimer. A disclaimer says you have no opinion. You do have an opinion. You said the numbers suck. Okay? You said they're no good. You said they're materially wrong and that you think they're wrong. That's an adverse opinion. You can't hide behind a disclaimer and say no. It's just like doing an audit and a review. We're going to talk later on about a downgraded services where you don't do an audit, you do less. You can't hide behind a review opinion if you did an audit. You go out and do this audit, and you do all the work and you verify all the numbers. You can't later on say, well, that's not what I did. You have to say what you did. So if you did an audit, you got to say you did an audit. You have an adverse opinion. You don't call it a disclaimer and say, no, I don't have an opinion. This is an example of disclaimer. I'm not going to read it to you. Where do these additional paragraphs go when you write them, okay? If you've got a basis for a modification, it goes before the opinion. A qualified answer goes in disclaimer paragraphs. If you've got emphasis or other matters, like you're talking about other auditors or going concern, it goes at the end after the opinion paragraph. So placement of the paragraph makes a difference depending on what you're getting under your opinion. This is a big chart. This explains everything I just did for the last hour. What happens if you have 2 or more report modifications? You're going to talk about both of them, and you consider the cumulative effects. What if you've got, a couple different reasons, you all of a sudden have something different? You have different opinions on different statements, sure. You can give an opinion on one and a disclaimer and adverse on something else. Again, let's go back to the beginning inventory. You're going to give an opinion on the ending inventory because you're there to count it. You got hired in November 14. You were there for the December 14 audit. You counted the inventory. You can give an opinion on the inventory, but you're going to give a disclaimer on the income statement and the cash flow statement. So there's nothing wrong with that. It's very normal. We usually get into negotiations with banks. I've had this with many times in my career. Client comes to me and says, bank, we're borrowing money from the bank, they need audited financial statements. And I go, time out. You're borrowing here in 14. Are they expecting audited 14 statements? Yes. So you tell your bank he's not getting audited income statements for 14. Why? Because I didn't audit 13. You didn't audit 13. You had a review for 13. You didn't count December 31, 13's inventory. I can't give them an opinion on the P&L, the profit and loss statement, the income statement for 14. You can have it in 15. You can have a certified, you can have an opinion on the 14 balance sheet. You can't have an opinion on the 14 income statement. It can't be done. Now, let's talk about one more circumstance here. Comparative financial statements. What happens when you have 2 financial statements? Well, you're going to express, you can have different opinions on the 2 years. You can have an adverse, you could theoretically have an adverse opinion and a clean opinion. Nothing says you can't. If you're changing numbers or you're updating opinions, you can do that. You're allowed to do that. What happens though, this is a very normal circumstance. Very, very normal. Most of the time, if you're auditing all the years, you don't have a problem. You're just going to have an opinion for both years. Not much going to happen. What happens when clients change auditors? The average lifespan. Anybody want to guess how long we have? What's the average lifespan of a client?
5 years.
5 years. 3 years. I hope it's not 3 years. You realize if it was 3 years, you'd lose 1/3 of your clients every year. What? We're averaging. 7 years is the answer. 7 years is the average lifespan of a client in a public accounting firm. It's less for public clients. You'll see a bigger turnover in public companies than you do in private companies. Okay? But 7 years, which means We average losing 14% of our business every year, which means to grow, you have to bring in more than 14% new clients to make up for the 14% you're going to lose. Now, you don't lose them always because you get fired. You lose them because companies go out of business, companies move. There's a variety of reasons why you could lose clients. Okay?
Or they want to corrupt the auditor.
Excuse me?
Or they want to corrupt the auditor.
Or they want to corrupt the auditor, or they downgrade services. Client goes from an audit to review. You go from all of a sudden a $100,000 client to a $20,000 client. That's like losing an $80,000 client. There's nothing worse than you get those phone calls. You get, hey, great news, the bank says I don't need an audit anymore. Oh, gee, that's wonderful, I'm glad. You know my favorite phone call is? You want to know about that? Listen, if you really think about a lot of businesses in the world, they feed upon adversity, okay? They feed upon adversity. Think about the people who do construction down the shore. After Hurricane Sandy, they had a great business, okay? Sandy, sure. My favorite phone call. Michael, it's your client. Yeah, hi, what's going on? I got bad news today. Oh, really? What happened? I just got a letter from the IRS. They're auditing me for the last 3 years. Oh, shucks. Hang up the phone. Chink, chink, service line. That's what we do. We help clients with the IRS. We're going to do more work. What's the worst phone call I get? The good news client. I got great news. I just got an offer to sell my company. I'm a rich man. I hang up the phone and what's my problem? I just lost a client. I got to say, oh, that's great. And we just lost an account. This is what happens, okay? It is. It's sad. So you realize, you're hoping your clients do well, but when they sell, you lost business. Sometimes when they do things like, great call is I'm buying a company. You get a new client. Now you got this new company that they bought. You want clients to grow. You want them to prosper. You don't want them going out of business, whatever the reason. So anyway, what happens when they got different auditors? What happens when you audited this year and they audited last year? Well, for the most part, you're going to own the company this year. So what do? The predecessor auditor can reissue the report, or most times, all you do is refer to the other auditor. You're going to put a paragraph in that says, you're going to say, we have audited, blah, 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 like we talked about, 2014. The financial statements for the year 2013 were audited by another accounting firm and have been included for comparative purposes and were covered by an opinion dated such and such a date. So you're going to refer to the other auditors. You're going to say, hey, listen, we did 14, someone else did 13. When you run into issues is when you audit 14 and you find out there's a mistake in 13. And that happens regularly. You find out the other auditors missed something, or other auditors find out you missed something. And that happens too, whether you're going to go back and re-audit whether you're going to reissue your opinion, whether you're going to make changes, or the new auditor is going to come in and re-audit what you did and issue the numbers their way. So there's a lot of circumstances when you have a change in auditors. The last part of this, and then what we'll do is take a break for a couple minutes. We'll start chapter 3, and then we'll finish sometime early. Is reports to the SEC. Let's just talk about what the SEC gets. If you go into working for one of the major firms, you're going to see these reports. There's a whole bunch of forms that are regular forms that are filed for public companies. Forms S1 through S11. Registration statements. What are those? That's when a company is going public. They're selling securities, either for the first time or later on. Companies continue to sell securities. They sell new securities. When they do, they have to register them. Securities that are sold on exchanges are registered securities. So the SEC tracks them. They know how many and who they are. And you have to register them. Private companies are not registered. Nobody looks over them. The SEC has no jurisdiction over that. You can do what you want. There's a couple things called SBs for small businesses. They're defined based upon the size of the company, and they're completely different sets of rules. The SEC doesn't impose the same restrictions on some startup company that's got $50,000 in assets as it does to some multi-global billions of dollar companies. They say, listen, You can't afford to do all the stuff that we require. These things are these are millions and millions and millions of dollars in legal and accounting fees to do. They certainly can't impose these on small companies, and they have a completely different set of rules. There's something called an 8K, it's a current report. It's to report changes, important events to the stockholders. So if something important happens, the SEC is immediately aware of it. It's also used, it's a very important form, change of auditors. If you as a public registrar change your auditors, you have to immediately notify your stockholders, you have to immediately notify the SEC, we change the capitals. They want to know, and you have to give a reason why. You've got to tell the SEC, we change them. Listen, they're very much on top of that stuff. Looking at companies and going, why are you changing auditors? What's your reason? Hey, listen, is it, and you've got to say if it's a disagreement over accounting. And the accounting firm has to respond to it. So if you've got a disagreement, they're doing accounting one way, and you as the auditor are doing it another, you say, listen, that's not GAAP, and you get into that fight over the difference in opinions, the difference in over accounting principles, and they go, good, we're getting new accounting. That form gets filed, and they say, we've changed from this accounting firm to that accounting firm. They've got to give a reason. You have a right to respond. It's like, hey, listen, that is a written record. 10Q. Financial statements. Companies are required, public companies, every quarter to file financial statements for the quarter. Accountants send to do a review report on these. This is not a 19K, it's an 10K. Wait, that's a 10K annual report, audited financial statements. We use different people to do SEC work than others. Okay, what we're going to do, take about 10 of them, start again. We're going to talk a little bit about Chapter 3 and ethics, and then we'll move on to the evening and continue next time.